Well, let's do another update on the mortgage REIT and equity REIT segment. And as you can see above me, I have bullet points of what I want to talk about. We're going to talk about, for mortgage REITs, we're going to use agency as an example of what's going on in the mortgage REIT segment. And there's a lot of terminology. We're going to look at a press release. There's a lot of new terminology that you may not recognize, and there's a lot of discussion that you may not know exactly what it means. Rather than me explaining as we go along, what I'm going to do is I'm going to do my commentary up front, and all of the teaching stuff I'll leave at the back end. So if you want to learn more about what a dollar roll is, what a to be announced market is, what a PSA, a mortgage pool PSA speed means, and why it's important for returns, all of that is at the end to help you understand the business of mortgage REITs. Agency put out a press release, a lot of good stuff in that press release. So we're going to look at that in a second. And then we're going to talk a little bit about equity REITs. Not a lot. We're just going to talk about the environment. Primarily, I want to point out an interview that was on Bloomberg on Thursday. The CEO of Starwood Capital, and Starwood Capital has properties across a number of REIT segments. And in this interview, especially at the 9-minute mark to about the end, which is about 11 minutes long, 9 minutes to 11-minute mark, goes through each one of them. And states what he sees going on. And I want to talk, before I introduce the video itself, I'm just going to talk about his view on the apartment REIT sector, because his numbers don't match up with another report that was put out on PBS. Anyways, let me answer one question that I seem to get a lot, and I got in one of the videos as well. I had put out a number of videos over the week. One was critical of a particular news channel in terms of, look, you're not really going to find good information on this particular channel. And another one was critical of these websites you see on the internet that sell you ideas. You give me money and I'll tell you what to buy. And I was critical of those as well. And the question was, well, how do you find information then? If you can't trust these people and you can't trust these people, what do you do? Well, you have to become your own expert. This is a business like any other business. If you're going to take some money and put it in a portfolio, it's the same as taking some money and buying assets and opening a storefront and opening a business. You're going to know something about the business that you're getting involved in. You're going to do some research. You're going to learn about that business. You're going to immerse yourself in it. It's nothing different here. You would not open a retail store and then wait for people to tell you what to do. You wouldn't sit there and say, well, nobody's telling me what to sell. I have nothing to sell. Who do I listen to? You wouldn't do that. You'd figure it out on your own. You'd do your own research. Same with this industry. It is a lucrative industry to be in. It is a industry full of opportunity on a regular basis. It is an industry where, with the right capital base, you can make an excellent living. You don't have to get employed by a hedge fund or an investment bank or any investment company. You can be your own. And as a small player, and small, by small I mean if you have anywhere from 20 million on down and you think 20 million's big, in this world, 20 million is not a lot of money. It's not. But I've known traders with a capital base of 250,000 that can earn 6 figures a year, that can earn consistently over 100,000 a year, because they treat it like a business. They manage their assets, they manage their liquidity, they manage their risk. They know when to take a loss. They know when to hold on to winners. They've learned over time. And the ones that do the best are the ones that have 2 big pillars. Number one, solid foundation in education, because there is a body of knowledge that you do have to know, and experience. Now, you can build experience without the body of knowledge. The problem is you're going to learn a lot with your own money. That education is going to be extremely expensive. There are words on these pages over here that if you knew them, you wouldn't make some of the mistakes you made over here. Yes, you still have to apply this. That's a big jump, taking education and applying it. But taking no education and trying to apply something, you're going to learn a lot on your money. You're going to tend to blow up a lot, and you're not going to understand why you're blowing up. So even if you have no desire to pursue a full education, a degree, or I primarily teach in the CFA space, level 1, level 2, level 3. I don't know that you're going to find a better aggregated body of knowledge about the finance industry than you would find in the CFA curriculum, especially level 1 and level 2. Level 3 is very specialized for more professional asset management. But level 1 and level 2, if you're going to be in this game, if you're going to be serious about this, if you're going to treat it like a business and say, I can make a business out of this, then you have to get education. So if you watch through to the end of this video, you'll see how I take some of that education and apply it to this. Anyways, for those CFA candidates out there, on the screen above me, you'll see level 1 fixed income. We're going to be applying concepts of fixed income to what we're looking at. Level 2, alternative investments. There's a whole reading on public real estate, which is REITs, which talked about all the different types of REITs and the environments in which those REITs tended to do better than the others. And level 3, capital market expectations, because that is what we're forming. And we're going to see an agency's press release where they do form one expectation about the future, which is the speed of prepayments. And at any point in time, this is where we are, we don't care what happened back there. We care about where we are, what assets we have under our control, and what the future looks like. Because it's the future that we buy, not the past. We want to know where to position ourselves for the type of future. So we're always forming expectations about the future in terms of what does it mean for the capital markets? What does this mean for equities? And in equities, what does it mean for cyclicals? What does it mean for defensive stocks? What does it mean for real estate? What does it mean for the REIT sector? So let's have a look at agency's press release, and then I'll come back and we'll talk about the equity space for a bit. All right, let's take a look at agency's press release. This came out April 8th, which was a Wednesday after the market closed. And agency's price gapped up in aftermarket trading and continued to remain strong in pre-market the next day and was strong throughout the day, mostly because the market was up, but on the strength of this press release as well. It had some good information in here. First paragraph, declaring a cash dividend, 12 cents per share. They're a monthly payer, so that's $1.44 a year. They closed Thursday before Good Friday at $12.40 a share. That's an 11.6% yield. Before all of this happened, at their previous trading price, they were $1.92 on dividends, which gave them about a 10 to 11% yield as well. So the yield is fairly constant, even though the share price has dropped and the dividend has dropped. The yield is intact on that one. The last sentence of the first paragraph is important as well. The company also reaffirmed its intention to continue its practice of reporting monthly estimates of tangible net book value per share of common stock. Why is that important? For companies, for mortgage REITs, their assets primarily, when I say primarily, we're talking 98, 99% of their assets are financial assets. So when we talk about the book value per share of one of these companies, it's better measured as tangible book value per share, because this is what we could get if we took all their financial assets and we sold them at fair value, because they're always listed at fair value. We sold them at fair value, took all the proceeds, paid off all the liabilities, shareholders would have that much left, whatever that measure of tangible net book value per share is. For mortgage REITs, that's an important number because it is an attractor point for the stock price. The stock price tends to be very close to tangible book value per share. Sometimes it's below, and you can buy at a discount to tangible book value per share. Sometimes it's above, where you're buying at a premium. So for those who like to trade the options, and agency has some nice options, when the share price is below the tangible book value per share, that's a great time to sell puts. Selling puts meaning that I'm willing to buy more because it's at a discount, but I'll sell puts. When it's trading above tangible net book value per share, now's a nice time to sell some covered calls. So you can play the options, and if you play them well, you can usually double the dividend over the course of the year. So if this pays $1.44 and you know the attractor point for the stock price, you can play the puts and the calls so that you can generate another $1.44 a year on your shares. So you can double the dividend. Dividend's 11.6%. You're talking about, even if you get no capital gain, even if this thing goes sideways for the longest time, it's a great cash generator, up to 22% a year if you judiciously play the options. That's a whole other video on how to play the options on that. And I will show you a stock chart for agency, and I'll show you how the tangible book value per share becomes an attractor point for the price. Second paragraph is just reiterating that, look, we cut our dividend, but it's also saying, look, we're in a great position to take advantage of a ton of opportunities, so look, we're going to conserve this cash. Now, contrary to what some people believe, a dividend cut is not always a negative. There are times where a dividend cut is actually a positive. So a company like agency, in the business that it's in, is probably looking at a whole bunch of opportunities around it. And when you get to the end of this video and you get to the learning screens, when we talk about, and they'll talk about it here, the speed at which prepayments will occur. There's a huge opportunity in the marketplace right now, but they're going to need cash to take advantage of that. Well, keep some of my cash. Give me my return in terms of higher tangible net book value per share, or give it to me in a dividend. I don't really care. If I take a total return perspective, the stock price can go up, or you can just give me more in dividends. I don't really care. As long as I'm getting my return, it doesn't matter how I get it. And this company is probably in a better position to take advantage of opportunities and to recognize what's an opportunity than I am. So there's no point in giving it to me. Go ahead and keep it if you're going to use it wisely. The next paragraph. I like the next paragraph. Lots of good stuff in here. Looking ahead, so we have some guidance here. We believe agency is well positioned to generate very attractive risk-adjusted returns in the current environment. A significant portion of the decline in our book value occurred during the first quarter was driven by reduced price premiums for higher quality specified pools, which we believe will reverse over time. Okay, well, why do you believe it will reverse over time? And the next paragraph really does it. We expect the disruptions to the housing market and mortgage origination operations related to COVID-19 will cause prepayment speeds for these pools to be materially lower than what otherwise might be expected. And if you understand negative convexity, mortgage-backed securities have negative convexity. That means when yields drop, they do not rise in price as much as straight non-callable bonds would rise in price, because the mortgage holders essentially have a call option. So at lower rates, we expect the speed of prepayments to increase. But here they're saying we have lower rates, but we're expecting the speed of prepayments to be materially lower. And if that's the case, then the fair value of their assets should be significantly higher. And when you get to the learning screen, I'll explain why that speed matters for the value of their assets. We believe that our retention of almost all of these assets through the recent market turmoil will be a meaningful driver of our future returns. I think they're right. If they are right, and prepayment speeds are lower than what the market anticipates, the price of these securities will rise. And since they held on to most of their assets during this period of time, and they're saying that that was a major decline in our book value, it should also be a major reason for an increase in their tangible net book value. In addition, agency MBS funding markets were fully functional throughout this recent crisis and continue to provide attractive funding opportunities for our portfolio. In light of these factors, we believe agency MBS assets, which enjoy a guarantee of timely principal and interest payments from the GSEs, the government-sponsored entities, which means you implicitly have a government backstop on it, which is beautiful, provide compelling risk-adjusted returns despite a very challenging credit backdrop. I agree with that entire paragraph. I read that and I think, okay, you're well on top of your business. I agree with this. And if this is the case, and we do see slower prepayments, that's going to be the big thing going forward, slower prepayments, then yeah, the recovery in your book value should be sharp. And if the recovery in your book value is sharp, the recovery in your stock price is sharp, because book value, the tangible net book value, is an attractor point for the share price. We also have a little bit more guidance over here. March 31st, 2020, estimated tangible net book value per share of common stock was $13.60. And they closed at $12.40, so they're selling at a discount. They're selling at a discount, and after what I just read, I would be comfortable selling puts. I would be comfortable selling the $12 puts on this, or the $12.50 puts on this one, because they are selling currently at a discount to a tangible net book value. And again, I'll show you the chart as soon as we're done this to show you how this becomes an attractor point. That's a $13.60 after deductions for common and preferred dividends declared through March 31st. Which is a decline of 23%. And it's quite typical that we should expect to see the dividend change almost in relation to the tangible net book value. So you have a drop of 23%, the dividend was cut 25%. Very close. If the book value dropped to 40%, we would expect to see about a 40% dividend cut. So if we want to know where the dividend is going to go over the next year, we would try to forecast what tangible net book value would be over the next year, and that's probably where our dividends are going to head to. Projected net spread. Net spread means interest income minus interest expense, that's spread. And dollar roll income, well, that's going to require some explaining. It's a form of financing. I'm going to leave it to one of the 3 teaching screens that are at the end of this video for those who don't want to sit through all of that. If you're interested in what dollar roll income is, you'll see it at the end of the screen. It's just a form of financing that combines financing with a short position, kind of. For the first quarter, excluding estimated catch-up premium amortization, this is a non-dollar cost, estimated to be in the range of 55 to 58 cents per share of common stock. So we got guidance for the first quarter. They expect to report 55 to 58 cents per share. So when their earnings are released, anything above this, that's bullish for the stock. Anything below it, it's going to be a little bit bearish, but there's our guidance, 55 to 58. So we know when they release their earnings what number we're expected to see. We'll see if they report in line or whether they beat expectations. They're talking about the amount of cash that they currently have available, $3.5 billion, and unencumbered agency MBS, $3.5 billion, which did not include another $1.2 billion of capital plus excess margin held at the broker-dealer subsidiary. So they've got a lot of dry powder that they're sitting on. March 31st, 2020, their at-risk leverage was approximately 9.4. Well, you got to know something about what a typical leverage ratio is for mortgage REITs. Anywhere from 9 on the low end, 11 on the high end, somewhere in there. Before all of this, they were sitting around 9.7. They're at 9.4, which is actually lower leverage. Now, here's a thing that you really, this is what education will help you with, is understanding how to use leverage. This is a highly leveraged type of business. And for some people who had margin accounts, maybe they owned this on margin, which means at 2-to-1 margin, you levered this up 2-to-1, which means you actually had almost 19 to 20 times leverage going on. When a stock has this type of embedded leverage, you do not want to use leverage to own it. And in fact, there are different ways that you would size this position in your portfolio. Perhaps if you have maximum sizes of 4%, that would still be too much. For something that has this much embedded leverage, you might want to size it based on volatility. And this is stuff you would learn at level 3. Which is determining the size of the positions you have based on either dollar value, based on some risk factor exposure that you want to maintain, based on volatility, some level of volatility where no position represents more than a certain amount of volatility of your portfolio. But because it's so highly leveraged, you don't want to use leverage to then buy something so highly leveraged. What else do we have here? We can ignore that. That was their leverage ratio, 9.4. March 31st, agency's total investment portfolio was approximately $93 billion, which includes approximately $21 billion of to-be-announced agency MBS. And I'll talk about the to-be-announced market in one of the teaching screens at the end. That's where the Fed is playing as well as in the to-be-announced market. So this isn't going to be important until you understand that, but we can pass on that. One more point to get to. The company's previously announced $1 billion share repurchase program, which was authorized by our board in July 2019, remains in effect. As of the date of this press release, the company has $0.9 billion, 90% of it left, $900 million in remaining purchase capacity available under the program. In this environment, I'd rather see them not use it. There's no need to repurchase your stock at this point in time. I think what you've said in this press release is supportive of your price. If prepayment speeds do in fact come in lower, and we see that month to month the tangible net book value per share is increasing, I see no reason why the buyback needs to support the stock price. I would rather see that money used for something else at this point in time. However, it's nice to know that they still have $900 million to buy back stock at this point in time. So there you go. There's a lot in here. Whenever a company puts out a press release like this, we should seek to understand every line and what it means. And the big statement in here is they've held on to most of their assets. We know that mortgage-backed securities have negative convexity, but they're saying, hang on a second, we have something that we think will nullify that negative convexity, which is going to be, contrary to what we would expect, a slower prepayment rate. Well, that's huge. And if you understand mortgage-backed securities and the convexity and the PSA speed on mortgage pools, you will immediately recognize that, hey, wait a minute, that means that the fair value of their assets is probably understated from what it really should be. That sounds nice. Let's have a look at the stock chart. All right, so here's agency over the last 2 years, and you can see that most of the time they're quite a low volatility stock. So they traded in a very tight range here, and then you can see that they dropped to a very low range in here. During this period of time, the average tangible net book value per share was around $17.50. So if we line this up around $17.50, there we are. You'll notice that there are periods of time over here where it traded above its tangible net book value per share. Then it traded below. It was brought back up, traded back down. Again, here we can see that it came back to its tangible net book value per share. Then it exceeded its tangible net book value per share. So if we keep our eye on tangible net book value per share, pretty much all mortgage REITs, well, I'll say most, because most that hold good quality stuff like agency should trade very close. The market price for the stock should be very close to that tangible net book value per share. We were told that it's $13.60, so if we drop down here to $13.60, there we are. That becomes the attractor point. You can see in yellow on the side that it's ended at $12.40. So we would expect that $13.60 would be an attractor point for the share price of the stock once volatility dies down, because you can see, look at these big moves here. That's huge volatility, whereas if you look over here, look how low that volatility is. These are daily bars right here. Look at this. There's almost nothing going on, especially during this period of time right here. You get bored with that thing. I mean, here you're looking at yield, right? And then you got some excitement here. But these periods of time, these are great for selling puts and selling calls, depending on which one that you want. If you can write some covered calls, you can put some cash protected puts in. When I sell puts, I fully intend to buy them. If they're put to me, I fully intend to buy them. I'm not speculating on them. I'm using them as a position in. I'll take them because we're trading at a discount to tangible net book value. I see no reason why tangible net book value will drop into the future. Then I'll sell some puts. So there's our stock chart. Okay, let's switch over now to the equity REITs. And here we're primarily I look at apartment REITs, retail REITs, and office REITs. I do have some healthcare REIT exposure, which I'm okay with. I don't know that I really want to add too much commentary to that. And I was asked about industrial REITs, which industrial REITs tend to have more long-term tenants with very large footprints. They don't leave easily. But once they leave, they don't get replaced easily either. I don't play a lot in the industrial REIT space, so I'm probably not the best person to offer any insight into that one. But for apartments, retail, and office, I feel quite comfortable on that. And in terms of safety, I'd say it's apartments, office, and retail at the bottom. And then with retail, you really, really have to look at the type of locations it has and the type of tenants that it has. And the interview with Starwood Capital CEO at around the 3-minute mark, he talked about retail specifically. And he said something in there that I thought, well, that doesn't surprise me actually. And he was saying that they have some very large national retailers that are going to be just fine, that don't want to pay rent because they're conserving cash flow. He says, so they don't want to pay rent even though they can. And then we have some small ones that really can't afford to pay their rent. So retail, he says, is probably the worst in terms of collecting the monthly rents, because the larger ones that can pay, they're taking this opportunity not to conserve their cash. In the office space, didn't say too much, but said, they're basically paying their rent. And it was in the apartment space that I found interesting. and he said that about 88%, for April, 88% of rents were collected, which is higher than another report out there saying about a third of rents are uncollected. And I had heard this on PBS. And by the way, while I'm on it, if you want a news source that's kind of right down the middle, they never take sides and rarely do they editorialize. And they push back on everyone they interview. They don't go easy on Democrats and hard on Republicans or vice versa. It's equal right down the line. PBS, I find, is very refreshing. It's just they're not yelling or screaming at you. They have no agenda. It's right down the middle. I can't speak more highly of the PBS NewsHour. Anyways, they had a report that 1/3 of tenants didn't pay their rent for the month of April, whereas Starlight Capital is saying, well, 88% paid their rent. And on PBS, they had interviewed 2 different landlords, individuals that owned their own buildings. They were significant holdings in New York. One, I think, had represented 3 buildings and 400 units, and another one was like 150 units in one building. But they're small players in that sense. They're individuals, whereas REITs are professionally run. So you have professional management running these companies. And that speaks to the type of tenant that you would have. There is a more rigorous process when you go to a building that is run professionally. There are credit checks. There's employment letters that are required. Some may even require background checks. I know that when I first moved to Toronto, I got a real estate agent to find me an apartment. And I had to provide, or at least I had to be prepared to provide permission for a credit check, and I needed an employment letter. And going in, most of the time, it's first and last month's rent and a security deposit, which is sometimes equal to last month's rent. So at any given time, they have 2 months' rent. And these are what the professionally managed buildings look for. They look for those type of tenants. So to hear that 88% paid their rent is not surprising, because they probably had a higher quality tenant to begin with, a better vetted tenant to begin with. And in the end, if for the 12% that didn't pay, they are already holding on to their last month's rent and their security deposit anyway, so their downside, I think, is quite limited on that one. 1/3 not paying the rent, that probably may be believable if you count all of the independent landlords out there that probably have lower standards or don't require the same number of hoops that you have to jump through to get into one of these buildings. Maybe they have first and last, and maybe their security deposit is half of the last month. Maybe they're in off-market locations, because to get into in-market locations, you're competing with professional companies that can outbid you, so they probably have less desirable properties. It could be a combination of a lot of those things, but I would naturally expect that a professionally managed building would have a higher number of people paying rent than an individual renting, only because chances are the quality of the tenant is higher in these professionally managed buildings. Now, there is some rumbling about tenants should not have to pay rent during this period of time. And they don't have to pay rent during this period of time. They can work with the landlord. They can defer the rent. They can't be evicted during this period of time. But there is no law, at least that I know, no legislation out in Ontario, in Canada or the US, that says you don't have to pay your rent at all, ever. This is a rent holiday and that's it. There is nothing out there like that. It would be, I think, difficult for a government to demand that a private group of citizens take a disproportionate hit. I know that you've invested in this building, but you are not allowed to earn any money on your building, and you're going to take the hit and you're going to take the loss, and your tenants are going to be rewarded, unjustly rewarded. And I say unjustly because, listen, they're still living in a place that they have to pay for. Yeah, there is a difficult situation out there, but it's not the landlord's fault. And, the idea that these are all big corporations, that's a lie. Okay, that I don't know who decides that that's a nice thing to say, but that's simply not true. These are not large corporations. These are large groups of individuals that have pooled their money to form a large corporation. These are pension funds. These are individuals who are holding it in their RSPs, holding it in their TFSAs. These are groups of investors spread across the spectrum of society. They are not just large, rich, greedy corporations. They represent millions of people who are invested in these assets. So to tell them that they must take a disproportionate loss, I don't know that there is political power to get that done. This week I had the opportunity of exchanging email with somebody who works for government supported housing. And I asked, have you heard anything? Because if there's anything out there, it'll probably show up there first. And she said, I haven't heard anything. So, okay, that's good. If it shows up there first, it may seep out into the larger market. But if it's not showing up there, if the conversation is not even there, okay, then I feel comfortable about that. So I do think that these rents will be paid in the future. Now, we had ugly jobs numbers in the US, ugly jobs numbers in Canada. The US, we're figuring somewhere between 10 and 12% unemployment. Canada is around 8%. It's probably higher, but there's a lag in the reporting. Well, let's take the 12% unemployment. Let's say it's as high as 12% unemployment in the US right now. And I say, flip that around. Don't focus on 12% unemployment. Flip it around. There's 88% employment. And when you think of Starwood Capital saying 88% of rents were paid in April, well, that's in line. That sounds about right. That's in line. If you can afford to pay your rent, well, you may as well pay your rent because you're not really going to get away with it. It's just going to build for some future point. So there we go with the apartment REITs. And I'm going to put all the links below. There's a bunch of links below in the description box for a whole bunch of good resources. The Bloomberg link is below. I don't think that I could speak better to the REIT sector and the real estate sector and the impact the Fed is having on it than the 11 minutes of Bloomberg that you'll listen to. So we'll wrap this one up there. And there's still some time left in this video where I go through some more teaching about exactly some of the terminology we saw. So there we go. All right, let's first look at the to be announced market, because this is where the Fed is buying. And to help understand why the Fed would buy in the TBA market, we have to understand how the process of mortgages are created. So let's start with the mortgage originators down here. They can either be banks or non-bank mortgage companies. And a borrower will typically approach them to get a loan. They're called a mortgage holder, and they would then purchase a house. And the mortgage would sit on the books of the bank or the non-bank mortgage company. The banks and the non-bank mortgage companies make these loans in the hopes of selling them to one of the government-sponsored entities, Fannie or Freddie. Fannie or Freddie buy a whole bunch of these mortgages, and they have to meet certain qualifications to be called agency mortgages. They have to be conforming mortgages and performing mortgages. They will pool these mortgages into large groupings, 1,000 mortgages, 2,000 mortgages, and sell securities against those mortgages. These are called mortgage-backed securities, which are bonds, and the payments on these bonds consists of principal and interest. That's basically the process. Here's the big problem. You need somebody to buy these. And the GSE has to know that somebody is going to buy these before they buy them from the mortgage originators. And the mortgage originators have to know that Freddie and Fannie are going to buy them before they lend money to the mortgage holder to set a rate. If I'm going to lend you money and I cannot then sell my loan to somebody else, then I have a higher level of risk. If I have a higher level of risk, look, I'm in the business of lending you money, I will, but you're going to pay a higher rate for it because I now have to shoulder all of the risk of lending money to you. But if I can sell it to somebody else, well, then I'm happy making my mortgage fees and a small spread. I'm good enough with that because I can sell it to somebody else, I can get my money back, and I can do it again and again and again. But if I only have $1 billion, I can only lend out $1 billion. Once I've lent out the $1 billion, that's it. I cannot sell those $1 billion worth of loans to get the $1 billion back to do another $1 billion. So all of this depends on the market for mortgage-backed securities. However, again, the GSEs are not going to create a pool of mortgages unless they know there's going to be a buyer. So there has to be a buyer in place before the MBS are set. In which case you need somebody to step in saying, listen, as soon as you create them, I will buy them. Well, what am I going to buy? I'm not really sure yet what I'm going to buy. I'm going to buy something that looks like this with these specific details. It'll be very close to this, but I won't really know until I get this pool of mortgages. But I'm not going to do that unless I know you're going to buy it. So the Fed says, okay, that's what we'll do. We'll buy these. And since these are not created yet, then they don't know exactly what they're going to be buying. That is why this is called the to-be-announced market. The GSE says to the Fed, hang on, now that I know that you're there, the GSEs then tell the mortgage originators, hey, we'll buy what you have. The mortgage originators then tell the mortgage holder, guess what? You're not going to be that risky to us, so your interest rate just got lowered. So the Fed buying mortgage-backed securities in the to-be-announced market allow all of this to operate and allow mortgage rates to be held very, very low because the originators aren't assuming the risk of that. And that's basically where the Fed is stepping in to ensure that the origination, the market for originations doesn't get caught up. Okay, let's explain the dollar roll. A dollar roll is just a form of financing, but a very particular type of financing that involves mortgage-backed securities. And to help understand the dollar roll and what's different with the dollar roll, let's start with a repurchase agreement, because we've seen repurchase agreements, we understand that. On day one, Company A will transfer an asset, we'll call it asset B, to a lender. And the asset is transferred to the lender as collateral. The lender will lend something like 98 to 99% of the value of this asset. If it's a high quality asset like a treasury, will lend 98 to 99% of the face value of the asset to Company A. But Company A agrees at the time that it transfers the asset to the lender to buy back asset B at time T. It could be the next day, it could be a 1 week, it could be a 30-day repurchase agreement, but agrees to buy it back at time T for whatever the loan was plus some known interest. So at some point in the future, Company A will come back to the lender and buy back that asset for a known amount of money. I'm going to give you your money back plus interest. During the time that this is going on, all interest belongs to Company A. So the lender is holding the collateral. If the collateral pays interest during this period of time, it belongs to Company A. And then at time T, Company A pays the lender the loan plus interest, and the lender transfers asset B back to Company A. That's a repurchase agreement. I have an asset, but I need some liquidity right now, so I'm gonna borrow money from you, and I'm gonna let you hold on to the asset as collateral. I'm still the owner of that asset, but you have it as collateral in case I don't come back and pay you. At some point in the future, I've agreed to come back and pay you. Here's your money, here's your interest, give me my asset back. That's a repurchase agreement. A dollar roll is used for financing purposes, but it has some peculiarities. On day one, Company A will take some mortgage-backed securities and sell them to the buyer or the lender. We're selling for settlement. Here, it's only for collateral. We transfer asset B to the lender for collateral. Here, we're actually selling for settlement. If we sell for settlement, that means the buyer or the lender now owns those MBS. All payments now belong to the buyer or the lender. And the seller, Company A, agrees to buy back some mortgage-backed securities 30 days later at whatever the price in the market happens to be. Notice up here, we're buying back this particular asset for the loan plus interest. Here we're buying back some similar assets, some mortgage-backed securities. I agree to buy back some MBS from you. It won't be these very ones I gave you. It'll be something similar at some later period for whatever the price in the market happens to be. So it is an unknown price in the future. It's not just the loan plus interest. It's whatever the price happens to be in the future. So on day one, Company A sells for settlement to the buyer and gets money, and with that money hopes to earn some kind of income somewhere else on that money. Now, the belief is that in 30 days, when they go to buy back those securities, they get to buy them back at a lower price, and that is called the drop. And we're hoping, or at least Company A has a belief, that the mortgage-backed security price at time T will be less than the mortgage-backed security price when they sold it, so they can buy it back at a lower price. In essence, it's like shorting mortgage-backed securities, except that you're the holder of them when you begin. You're selling them with an agreement to buy those very ones, not those very ones, sorry, to buy mortgage-backed securities back at some point in the future. So day 30, Company A buys MBS from the buyer or the lender for settlement, which means they no longer belong to the buyer or the lender. They now belong to Company A. And the belief is that the income earned on the money from selling the MBS in the first place, the income earned plus the drop, how much it dropped by, would be greater than the coupon and principal received by holding on to that particular asset. If you're right, you earn a positive dollar roll return. If you're wrong, you lose money on your dollar roll return. So why would two parties agree to this? One believes they're going to make money. The other believes they're going to make money. In any market, that's why two people do anything, is both sides think they're right, and off they go. So that's the difference between a repurchase agreement and a dollar roll. All right, we're going to cycle through all three levels here of fixed income. We're going to see things that we've seen at level 1, level 2, and level 3. Level 1, we introduced the very introductory readings. We introduced the price-yield relationship on bonds, and we found out that we have a convex price relationship. So if we plot price on the y-axis and we plot yield on the x-axis, and you changed the yield of a bond and measured its price, it would draw out a convex shape. That is for a typical non-callable bond, just a straight bond. We learned that as yields drop in the marketplace, bond prices tend to rise. And it would look like this. A mortgage-backed security, on the other hand, is different. It will not behave like a straight non-callable bond because the mortgage holder essentially holds a call option. So prices don't rise the same way. Notice that this 100 represents par. And as yields drop, the mortgage-backed security price will rise up to a point and then will get pulled towards par because a bond price at any time is the present value of all future cash flows. Well, at lower prices, at lower yields, I should say, down here at lower yields, mortgage holders are refinancing and paying off their mortgage, which means all of those cash flows are coming forward very, very quickly, which means they are not being discounted for a very long period of time, so their price is pulled towards par. So they can refinance their mortgages at a lower rate. You end up with a pool of mortgages which has a higher speed of prepayments. That's called a PSA. It has a higher PSA. And this we saw in level 1 in the fixed income reading. A PSA of 100 means there are no prepayments on that pool of mortgages. So that means all we're going to get are our scheduled coupon and principal payments, and that's it. They'll never pay it off any faster. If rates increase, we expect the PSA to drop down towards 100. If rates decrease, we expect the PSA to increase, which means we get paid faster and prices tend to do this. Prices tend to be capped. What would be beautiful is if interest rates dropped and the speed also dropped as well, so that we started to get bond prices that tended to look like this over time. Notice how we can get higher prices for our mortgage-backed securities at lower yields if people just don't prepay. But that's not how it works. They prepay. Lower rates equals a higher PSA equals faster prepayments, and when mortgage holders prepay, they prepay the face value of the mortgage. They do not pay the present value of future payments considering lower rates. That would be the bond price. So if there were no prepayments, we'd be up here on price. With prepayments, we're down here on price when the yield drops. So the value of these securities don't go up very much. Now, what agency is saying in their release is we have lower yields. This happened, but they're saying they expect the speed of prepayments to be considerably slower. What gives? We expect it to be faster. Well, we have a very unique environment right now. We have an environment where we do have lower rates, which is supportive of bond prices, but if homeowners are not going to prepay any faster, it also allows mortgage-backed security prices to rise above par, which is what we want to see. And that's what they're saying, is that, look, a lot of our good quality stuff got hit because of these lower rates, so they're being pulled apart, but we don't think the speed is going to be what the market typically believes the speed should be at these lower rates. It's going to be much slower, which means the value of these bonds should be significantly higher than what our fair market value is right now. Why do they think that speeds are going to be lower? Yeah, rates are lower, but so are household incomes. And since everyone is conserving cash right now, the idea of prepaying your mortgage, where you can make maybe double payments or make a 15% payment on your mortgage. Some mortgages allow for that kind of thing to happen. Most homeowners may decide that, you know what, it's probably safer to sit on cash for now and let's see what happens until we have more clarity. Much like companies do, we sit on cash for a while. Not only that, banks are a little more reluctant to lend, so they may not be able to refinance. Perhaps somebody got a mortgage when the major income earner had a job and now they don't have a job. They have 2 years left on their mortgage. Mortgage rates are lower. They could refinance now, but they'd never qualify. So that's why they believe that the prepayment rates will be slower. These are agency mortgages. They are guaranteed by the government entities. They basically have a government guarantee backstop to them. So if a company like Agency, which has a whole bunch of agency MBS on its books, if there are defaults, it doesn't matter. These are government guaranteed. They're government guaranteed. We have lower rates, which is supportive of higher bond prices. And we expect a slower PSA, not a higher PSA, which means that the fair market value of these bonds should recover nicely over time. And that's why when we read that section on Agency's statement that says it's going to be a major driver of returns going forward, now you know why it's going to do that.